Hi, and welcome to the next episode of the Flow podcast, where we talk about the market structure in the digital asset space. And my name is Konstantin Shulga. I'm the co-founder and the CEO of Finery Markets, the leading ECN and electronic trading SaaS in the digital asset space. And today we have a great guest, Tom Higgins, the founder of the Gold Eye. Tom, really glad to have you here.
Well, thank you so much for inviting me. I'm really honoured. You're a beacon in the industry, so it's really exciting to be talking to another CEO and co-founder. So because I think we share similar values on things, which is nice.
Exactly, and especially with your background, I think it's always great. Before we dive deeper into the weeds of the market structure, it's always great to start on the personal note. And you are in the market for quite some time.
Yes.
You've been building the market structure for since I guess 80s. And can you share about this pivotal moment in your life when you decided to move from the brokerage side and actually start your own business? How did you make that decision?
Yeah, it's an interesting one, isn't it? Because when I was employed, when I had a real job, as I like to call it, when I was employed, before one becomes unemployable as your own business owner, I always wanted to be an entrepreneur. I always wanted to start my own thing because whenever I worked somewhere, I could see things that were just systemically wrong. And I just thought, you're just doing this wrong. Either at board meetings where people were making decisions based on things they were making the wrong decisions because they didn't have the right information or they weren't bought into it enough. And it's so common, not one particular company, just everywhere. And so I did an MBA. I had a really good boss at a company called the International Petroleum Exchange, which is the oil markets. And it was a trading floor, a physical trading floor with people running around in bright jackets. Anyway, he was really good, this guy. And he said, you need to do an MBA and we'll fund it because you need to understand more about the whole of a company rather than just the technology side, because I was a technologist. My degree was in electronic engineering and digital computing, and so I wanted to, as they called it then, I wanted to have a bit broader scope, but I didn't know how to do that. So he said, we will fund you to do an MBA, and I thought that sounds like a good idea, so I did
nice
that.
Journey, yeah.
Yeah, I actually left the company after I'd finished it, which I felt.
Did you pay for that later?
No, he didn't. He was so nice about it. He didn't make me pay it back or anything like that. They weren't that expensive then. They're not like US MBAs. But it was still probably £25,000. It's not cheap, but it's not hundreds of thousands. So
it's your small golden parachute.
Exactly. Yeah. So that, and what I found from doing the MBA was. It's not a sort of silver bullet to solving everything, but it makes you understand every single part of the business. So you can talk to an accountant, you can talk to a marketer, you can talk to sales, you can talk to technology, and you understand enough to have a sensible conversation and be able to make decisions. But you don't know everything about all these areas, and you don't need to. You just need to know enough to get the right people. Exactly. Because, as I'm sure you find, employing people better than you is always the right thing to do, because otherwise what's the point? So after I'd done this MBA, which was in 1999, I was then really sort of itching to find something, and I kept just sort of scrabbling around trying to find what to do. And the thing that pushed me into actually starting Gold Eye was losing my job in 2008 and thinking, well, what am I going to do then? So I thought, well, this is if there's any time I should do it now. And I thought, well, maybe I've got some skill that might be useful. And very quickly, it became obvious that there are not many people who have business domain expertise and deep technology expertise, because I was a C++ developer, but I also understood the FX markets in depth. And that's unusual. And also technology people who can actually speak to people and can communicate ideas clearly is a bit unusual. So I had to sort of realise that was a thing that I could use in my favour. But fairly quickly, that sort of did become the case. So the things that I was worried about when I started the business were silly things like, how do I pay VAT? How do I manage PAYE? How do I do all of these admin things, which are things that are just, you shouldn't need to worry about those things.
You don't want to solve these challenges, you want to solve the market challenges, right?
So fairly quickly you realise actually they're just mundane. You employ an accountant and they solve all those problems. And actually the issues are, how do I build a product, and how do I stay ahead of the market, and how do I stay relevant, and all that sort of stuff. So I then really got the bug, and I couldn't be employed by anyone again, I don't think.
Yeah, well, I think that's once you get this, once you kind of stepped into these waters, it's hard to step away from being an entrepreneur and changing the market structure. I think that's you've been one of the advocates of the FX from the early days.
Yes.
You've spent, I guess, almost a decade building the products before you launched and before you stepped into the crypto space.
Yes.
So what inspired you to actually test the waters with crypto?
Well, I'm a technologist at heart. I absolutely love things like that. I love shiny things. And so when I saw, so I sort of keep up to date on what's sort of going on in these things. And when I saw what was happening in the crypto space in the very early days of sort of Mt. Gox and stuff like that, these exchanges that were, it annoyed me they were called exchanges because I'd worked in proper exchanges, as in regulated investment exchanges, sort of like the life markets, IPE, NASDAQ, these sort of places that are a very, very different structure. So I saw these things appearing called exchanges, thought, that's interesting. They've created this whole grown-up infrastructure. And then I looked and realized, you're not an exchange at all. You're a sort of web page that's matching people together sometimes.
Well, most of the terms in crypto space are kind of misused.
Yeah. So I looked and thought, okay, this is interesting. So we thought, well, how can we provide services in this area? What can we do? So there are various people interested in getting a streaming price because you couldn't get a reliable Bitcoin price at the time from one place. So somebody said to us, okay, we will pay you to aggregate some price feeds. So for not trading, just for pricing. And so we aggregated a couple, and they said, well, that's not reliable enough. The latency, I seem to remember, we got from one was hours in pricing. If they had a problem, they would just back up hours. And they had no phone lines.
Can you name what was the venue?
I can't even remember which one it was. It wasn't Mt. Gox, but it was another one. I began with a P, and I can't remember which one it was. But it was Poloniex, might have been.
Might be. Yeah.
I'm not even sure that exists anymore. But anyway, they had no phone numbers.
They were bought out. Yeah.
You couldn't talk to anybody. So there was nothing you could do. And they would change, you'll probably remember this too, they would change the APIs on the weekend without telling you. And suddenly on the next day, nothing works.
Something breaks, yeah.
Yeah, it just doesn't. It's like, why does it not work? Well, we changed the APIs. Oh, thanks. Thanks for telling me. So we ended up having to aggregate 9 different price feeds to get a reliable price, which was just extraordinary. So at that point, I thought that this is not a viable liquidity source for our sort of clients, because at that time we were looking at providing this liquidity to retail brokers. So I thought, this is just not reliable. They're used to having someone they can phone, I've got an out trade and I need to talk to you now.
Yeah.
Within minutes, I need to know whether I've got to flatten my position or what I'm going to have to do. Do I have a position or not? Do I have risk? If you can't talk to anyone, what can you do? So we sort of backed off a little bit. And then when market makers started appearing, so when the futures market makers started getting into the space, I had a conversation with FXCH, so I think you will be familiar with Frank at FXCH. Yeah. So he said, well, we've got this idea of creating a clearinghouse from the FX clearinghouse we created, creating a crypto clearinghouse where all the market makers can then have their trades novated into. So you only need to face FXCH and you can trade against all this low liquidity. So that's a really good idea. So we integrated, I think, 27 market makers. There were many, many at the time.
Yeah.
And a lot of them in the States. We went to see them. They had a lot of money. They had enormous boardrooms, lots of stuff. And then next time we went to see them, they had a lot less space, and some of them still had the big space, and they were all losing money. And that worked pretty well actually initially, but then when one of the winters, there's been a few, haven't there, came along, they collapsed because they didn't really have a business model that was sort of that viable, and it was more proper hype period, I think, and so that the next winter came along and a lot of the market makers disappeared, and then the exchanges started getting a bit more concentrated. So you started seeing Binance, of which I thought, well, maybe this will be quite useful. Started getting really dominant, more and more dominant. And other ones sort of falling back a bit. Coinbase being less relevant. Ironically, it's now becoming more relevant again, I think, but becoming less relevant at the time. And other people like sort of Bitfinex that had a go, starting to get a bit more sway, and so they became a little bit more interesting again. So we thought, what we need is to have some sort of prime broker system. So I worked at ODL, which was bought by FXCM, and a lot of the guys who set up Hidden Road either worked at FXCM or were connected to people at FXCM or Jefferies or all that network. So I knew them very well. And so in chatting to them, I thought this is a really interesting model because this allows you to have the sort of stuff you had with FXCH, but on a larger scale, and it worked really well. So we worked with them a lot, integrated with them, brought on board lots of market makers, because whilst they don't have liquidity aggregation, they have all of the bits afterwards that we don't have.
The capital efficiency, which is the game changer, I guess.
Yeah, so I think that was sort of big game changers. So we then integrated with more and more bigger market makers, and as we did more came to us and said, we want you to integrate with us. More exchanges, people sort of more modern ones, sort of like Bullish and people like that, who have a different model with their automated market maker. OKX, who are really go ahead, excellent support, really easy to talk to, really interesting guys who want to do a lot of stuff.
Yeah.
So lots of more there, and then we sort of thought, we had some crypto clients who were running algos and were taking liquidity, and we said to them, we think there's a really interesting opportunity to replicate the prime of prime model that exists in FX, because we were finding, and HRP was saying to us, that they were turning away lots and lots of clients because they can't face them, because the clients are too small, or they can't onboard with them. KYC against a big company like Hidden Road takes months. Exactly. and most people can't do it, because if they don't have the right structures, because they're a highly organised and structured company. So you need an intermediary. You need someone in the middle, which is why it developed in TradFi to be like that.
Exactly.
So we took a couple of our clients and said, well, have you thought about doing this? They were very entrepreneurial and they were interested in ideas.
Yep.
So I said, have you thought about doing something like this? And they went, well, okay, let's have a look at this. And so one of them completely restructured their business, stopped all their algos, changed everything around, took all our technology, and it helped us take it to the next level. And it was a lot of work, I must say. It's a lot of work doing that sort of stuff so that they can sell liquidity. And then we've now got 3 doing this. Selling liquidity to other people, and the number of leads coming in who can't onboard with other people is good, and that's in spot and perp. So we are seeing now inboard leads for either for the liquidity with our partners, or for technology. Most of our interest is in the crypto space rather than FX. It does come and go, and we have lots of good clients in FX. And the good thing is it's a single platform, so a single code base, matrix net, which supplies the crypto industry and the FX. So when we do work in one, it often benefits the other one. There are some things like booking that you do in FX that you don't really do much in crypto yet, but you will, I'm sure.
Yeah, well, with the less volatility in most of the asset classes and with more mass adoption, I'm sure, it will be more and more. And
Absolutely.
Still, that some of the largest brokers, they do book most of their business, including crypto, even today. So
some of them do it because they don't have any other way, and they just sort of hope. They just
maybe they're too big already, so that they have a nice balance sheet backing up all. They could be.
One of them said to me, and I won't say who it is. They said, "We just hope nobody trades too big on it, because we don't really have any way of covering this stuff. So we just book it and hope it doesn't all go a bit wrong."
But hopefully, as we all know, the learning curve actually leads some of that to splitting the risk, and actually we will see some of those guys doing the A book and the B book, and there will be more knowledge in the space. So we're happy to address that, I guess, with your help and our help here.
Yeah, one of the other things actually that we realized we had to do was the protocol problem. So I'm not talking about DeFi protocols. I'm talking about like Fix, WebSocket, REST, that stuff.
It's not standard.
The pure play crypto people go, I use WebSockets, and what's this Fix rubbish? And the TradFi people go, I use Fix, what's this WebSocket rubbish? I'm not talking to that. And so we've had to build on the taker and the maker side adapters into WebSockets and Fix so that we can do either. And it's quite interesting that I was talking to someone, the institutional at Binance, and they said, this is a few years ago, and they said, you don't need anyone else, you just need us. So the institutions, they will come to us, they will integrate WebSockets into all their platforms, they will deposit all their money with us, there will be no custodians. And I said, I just think you're wrong. Because on pretty much all those fronts, is because these guys are very traditional with their technology. They don't like doing new things because they don't want to break things. So they're happy with Fix because they know it. They know they can connect another Fix feed. But if you tell them they've got to get developers who can do WebSockets, it's a hurdle they don't need. If you tell them they've got to deposit all their money with you, they'll go, that's a bit risky, isn't it? What happens if you go wrong or something happens or one of your CEOs goes to jail?
I think no entrepreneur should underestimate the power of legacy systems and habits in the traditional space. I mean, we can always build new stuff and new great products for the new generation. But if we really want to tap into the traditional system, there need to be a few bridges, and probably Fix is one of those bridges that allows the traditional space enter the digital assets.
Yeah, and I think, I agree entirely on that one. I think the other thing is I have a sort of phrase of just follow the money, which actually came from the regulators, where when they're looking to regulate a market, they look, where's the money, and that's who we should look after. So that's why they don't really look after tech providers, because we don't have the money. They look after the funds and the banks and things, because they have lots of money. And so if there's some new exciting technology, and like blockchain came along and the real crypto bros said, right, we're going to wipe out all the banks, they're all going to disappear. So you're not, because if this is so fundamental and so amazing, the banks will just buy it because they have all the money, so they can buy anything. So if there's something amazing, they will get into it. They won't just roll over and die. They're rich enough to be able to buy into that sort of thing. And it started actually with the traditional exchanges, like NASDAQ, just buying everything. They have so much money, and they just buy and buy and buy and buy.
And like NYSE buying the EC and like Archipelago.
Yeah, it's incredible, isn't it? Yeah, well, and why would they not? So I still follow the money. I think that still works quite nicely, actually.
Exactly. Well, I think we'll still have some outliers in the DeFi space that have grown quick enough, and now they also are quite powerful financial institutions, even though they don't treat themselves like that, but they already have accumulated sometimes hundreds of millions just in the revenues from some of those breakthrough models, and now they're kind of becoming quite big for any bank to acquire them. So it's also nice to see how some of those institutions are emerging.
Yeah, absolutely. I mean, I did a panel yesterday at the FX Expo show talking on cryptos, and we were talking about DeFi and whether banks could adopt it. And the sort of main thing people were concerned about now is, because you don't know, because it's all about operating in a world where you don't know who the other person is and you don't need to know who they are. Well, if you're a bank, you do need to know who the other one is, because they might be a terrorist and you can't deal with terrorists. So how can you do that? So we decided that actually you really need technology to be able to not need to know who the person is, but to know that they're okay. Yeah. So as long as you can know, I don't know who you are, but I know that you've been KYC'd or KYB'd by some entity somehow, then it doesn't matter. And I know you're not a terrorist because you had to do this. So that's quite nice. And DeFi, that would work as long as you could know who the other side is. So I think the whole thing is quite interesting, DeFi. It's much more exciting technology than sort of central markets, which are it's the same sort of stuff. You're matching things together, whereas DeFi is really clever, and the whole sort of concept of the blockchain past Bitcoin's rather basic one of having smart contracts and then distributed applications with little bits all over the place, all talking to each other. I think that's fascinating.
I totally agree with that. And we actually, on our previous podcast with Rob from Dragonfly, we chatted about the use cases in the DeFi and the on-chain space, and we really agreed that building a matching engine on-chain doesn't make a lot of sense.
No,
because you can still run like a perfectly smooth operations, which will be way more efficient on just a C++ low latency matching engine, which can be centralized. But then when it comes on the clearing side and the post-trade settlement side, that's where the magic can happen, where the blockchain technology can actually help and bring more efficiency on the capital side. And maybe I'm looking forward to partner with some of the projects on the borrow lending side that can be built on top of some layer 2 protocols. I think that's the actual future of applications. It's the mix of off-chain parts where I think execution can happen off-chain, and then some of the post-trade that should be optimized via the on-chain technology.
Yeah, it's when something new comes along like blockchain, people want to use it for everything. Yeah, and they sort of what happens is they realize actually there's technologies that are really good for some things, and other things that are really good for other things. So databases are pretty good for a lot of things, and blockchain is not very good for some things. So use the right technologies for the right things. It's never going to be as fast as some things need to have. It's going to be absolutely fast enough for a lot of the settlement and things like that, and it gives enormous benefits.
Yeah.
But trying to use it for something like pricing is just wrong. It'll be horribly expensive and inefficient way to do it, and you don't need to. Why does it need to be mutable? It doesn't.
Yeah, totally agree. Yeah, you always need to have like a filter, thinking whether that makes sense in order not to kind of polish it to perfection, because it really won't bring any value add, I think, versus just the traditional C++.
Yes, I agree.
stack.
I think KYC is another really interesting area, because I love the idea of being able to KYC against a third party.
And share a token.
And share it, exactly. Because as we have integrated, although we've integrated with multiple exchanges, every exchange I have to personally onboard with, because they don't have like development partnerships, they don't have any of these things. Most of the time, they don't even have a testnet or a UAT system. So we have to put real money in to test our code, which is ridiculous. And I've had to KYC with so many, and it's annoying. And I love the idea of a third-party token. I give you my token, and I can then say which data you can access, and you can see who I am, and you know that it's actually me and my passport and my data, because it's been improved digitally.
Exactly.
But why it doesn't really happen yet with any banks or anyone.
Not yet. Well, I think there are a few companies like SumSub,
Yes,
and they're already working on that. It will take some time, but then the next big step would be to automate the KYB part, which is way more complex.
Yes.
And that's where we see. I don't think that might be fully put or like fully digitalized within the next couple of years. So that's why the role of the PBs, going back to that, is as just simplifying the onboarding process with all of the market participants. I think this is also a huge value add for the guys like Hidden Road or FXCH and LTP.
Yes.
So. Well, we've already touched a few different topics, and I think Goldeye will celebrate 16 years anniversary this year.
Yes,
right?
it will do. Yes, in September, our 16th birthday. Yeah.
So over that 16th path, what are the key breakthroughs that you saw happening in the industry, both on the FX and crypto side? Maybe you can draw some parallels, and what was the most kind of exciting moments on the industry within that journey?
Yeah, good question. So in the early days in 2008, it was the Wild West in FX. There were brokers being created daily. We would probably, in a week, we would probably have sometimes 10 brokers, new startup brokers had been created to use our sort of technology. It was mad. And they would go bust very quickly. The churn was insane. You were on about 80% churn probably a year of brokers coming and going and coming and going, coming and going. And they all wanted the same thing. They all wanted MetaTrader 4. That's all they wanted to have. And it, by its design, doesn't have any ability to connect to liquidity. It's designed as originally designed as just for the Russian market, for booking everything. Brokers would run away when they made lots of money as a big broker and start another one. So it wasn't a terribly sort of grown-up model. But what it did have, and the reason it became so incredibly dominant, was the APIs. So it had really, really rich APIs that allowed you to make it do things that it was never designed for, but allowed you to get into the guts of the thing and pretty much put hooks into everywhere. So to change its behavior. And that's where the concept of the sort of bridge came about. So my sort of light bulb moment, I suppose, came on when I was looking for technology at ODL to do this reliably. I found a couple of people who did it. There was a company called Boston Technologies, which is gone now, which did it, but very unreliably, because they were using the wrong APIs, and it was outrage all the time. It wasn't possible. So we were one of the first people to integrate using something called the server API, which was much harder to do, but it was much more reliable because you were hooking right into the guts of the thing. And so when we created our first bridge, as the term was used then, just for that little bit of adapter from MetaTrader into other things, we decided to make a generic fix adapter so that we could then do other things with it once we'd got it into fix. So that was the sort of breakthrough thing, was back office connection and bridge. So you could connect it into CRM and back office systems, because people tended to use external back offices then. They don't so much now in retail. And CRM systems they do, but really just feeding sort of liquidity in. We had some really good first clients who, like your first clients, they are either very supportive or they're not aware that they're the first client and that they're the guinea pig. But you just, as you know, you just stay ahead of the game enough. You burn a lot of hours, don't you, sort of getting it working and things. So I do remember demoing something to one prospective client in London years and years ago when we were very early on. And I showed it to them and they said, well, it looks good, but the spreads look a bit weird. Anyway, so I hoofed it back to a coffee shop, logged onto the system, looked at the code and realised that we'd made a mistake in the spreading logic, fixed it, went back to them and said, oh, yeah, sorry, the config was wrong. And those are the sort of things I think that entrepreneurs accept is what you do to get it going. And then you morph into a grown-up company where you have lots of procedures and processes and QA systems and proper test teams, and you have to change world into being, producing something sort of grown up. So I think that first pivotal moment was thinking that this is something here, creating this sort of bridge type of thing, and then sort of growing there. Then moving forward, I think the next bit would probably be thinking actually single connection to a liquidity provider is a good start, but what you really need is reliability of multiple connections and leading to aggregation. And so we had this concept of, I called it Matrix because it was lots of data coming in and lots of data coming out. So we called it Matrix. It's now Matrix Net because we decided though to give it a little bit of a fresh branding. Allowing you to connect to multiple sources coming in, do all sorts of funky spreading and aggregation and reliability to sort of fail over. If one stops, you can feed it from another one, all that sort of stuff. And then hook that up into MT4, MT5, CTrader and all dev experts and all those sort of platforms. So that's the sort of next moment, launching that. And then I would say probably next bit was our Visual Edge product. So realizing that there is an awful lot of trading that they can no longer analyze, the brokers themselves. The tools in MetaTrader, so we're looking at MetaTrader specifically in this case, the tools in MetaTrader for risk management are not as rich, to be nice, as you need as a broker. Because if you've got hundreds of thousands of clients who are hunting you down to try and take you out of your booking, you need really rich risk management tools. And we built that in our product called Visual Edge to allow you to sort of spot the sort of stuff that you don't want to know is going on. That's actually led to, which I don't like to call it AI yet because people think that means it's generative AI type stuff in there, but it's machine learning, so learning patterns and then showing you that these people are doing these things against you and you probably don't want this to happen because you're losing money. And so helping show people on latency arbitrage and things like that. There's all sorts of really funky things that they do to try and cheat you, buying and selling different places at the same time, trading small size and bigger and bigger and to test to see whether they can actually make money or rip you off somehow. There's all sorts of things that they do. So finding that sort of stuff. And then the last one really was crypto. So realizing that there's not much technology only provision of what I now call us as an EMS system, because our job has been, you want to buy and sell some cryptocurrency and our job is to make that happen. And it's not as simple as an FX where you just split it to one LP and they'll almost certainly fill whatever size you want in one go and it'll just work. It's, as with all the stuff that you've done with all the different market making things, it's a little more complicated. There's book hogging at the top of the book where you haven't actually got any volume to keep your showroom window looking the best. There's I'm the best price, but I'm not ever going to feel you at that price. I've got 100 Bitcoin available, but I'm only going to sell you one. So we have to do all sorts of really clever things. So I think sort of making that move and realizing that actually we've got a real edge here, and the knowledge that we have, the connections we have in the market, the people that we have that we know, the trust that we have, is an edge, and so sort of realizing that and then building that product, and that's going really nicely now, and it's nice to be sort of seen as sort of one of the leaders in that space.
The veterans and the leaders, yes, exactly.
I know. Well, it's I love the way they describe crypto years as dog years, don't they? Because it's 7 years to one, isn't it? So things that happen. I mean, some of the brokers that we took that were originally just consuming that are now liquidity providers, they've done it in like 8 months or something, things that would have taken years. in other markets. I mean, in equities, you would have taken 10 years. In FX, you'd have taken 2. And in crypto, you do
A few months.
a few months, yeah.
Exactly.
And you break it and you learn. You break it and you learn. It's that sort of model, isn't it? You just keep trying. You keep trying.
Yeah. And actually, you've already touched like a few different asset classes, and your background is mostly in FX, and crypto is it's been debated for a few years. Like, what are the asset classes that have most in common with crypto?
Yes.
So what's your stance, whether it's more FX, crypto, or maybe like commodity market structure?
Yeah, I mean, my original background is actually all in futures and options at the traditional exchanges. So I only got into FX after probably half of my career. I sort of got into FX and then found it amazing. And so it's so much more exciting than just the futures and options side, because it was so much more scope, it's so much bigger and so much more interesting.
More flavors of different
absolutely,
effects,
yeah, and also far less expertise in the brokerage firms. They really need help from technology providers. They don't know much. Yeah. Most of them don't have IT departments. You have to do everything for them, literally everything.
Yeah.
So to answer your question, what does it look like? It depends which cryptocurrency you're talking about, is my view. So if you're talking about BTC and ETH, it's like gold. It's a commodity. And I'm sure it was designed like that by this mythical person or team or whoever it was who wrote the white paper, because it's mining, it's called. So, you're digging for gold. The fact that it has a finite amount of this stuff, the fact that it's like gold, it only has value because it's limited in quantity. Gold's quite shiny and nice, but if it was dull, would it be the same? Should be. I guess platinum's not terribly exciting to look at. It's not sort of yellow and shiny. It's sort of silvery and shiny, but yet it's fine. So it has that the clever design of the fact that it's limited amount that you can create. You have to work to get it. So you've got to do the mining. You've got to do some work and expend some money. You're competing with other miners to get to the seams of Bitcoin down there. So I would say that's a commodity. It's definitely doesn't look like a security to me, and it definitely doesn't look like a currency. Whereas if you look at the stable coins, absolutely look like currencies. They are not they're not a store of value. They're used for transactional purposes, and I think they're extremely good at transactional purposes. They work really, really well, and I think it's for areas of the world that are very poorly served by banking. They're a brilliant solution.
Yeah, and I could not agree more. Probably like the difference between ETH and Bitcoin is still like, would you still consider ETH the same kind of commodity type? Because it has way more colors into that, with like all of the smart contracts around the Ethereum ecosystem, which kind of has like, according to SEC, some statements, but which were withdrawn like last couple of days.
Yeah, it wears two hats, I think. When you're using it as a speculative instrument, it's wearing the Bitcoin hat.
Yeah.
But it's a utility token. It's one of the few coins, that really has proper value in the original sense of creating
powering
a token. Powering the ecosystem, exactly, and Solana and things like that. Most of the ones that are actually useful are doing something good, are doing something useful, like powering a blockchain of some sort. Those that were just invented to create a token to do an ICO, most of them are pointless. So when it's wearing its utility hat, then yes, it's a completely different thing, and it's really powerful. And I think I'm so impressed by what they've done with it. But yes, I'd say it's interesting that you're right to point out that it is different. It's not just solely used. And the Bitcoin, often people say it's like the car with the red flag. The first cars, someone had to walk in front of the car with a red flag because it was so dangerous. Its blockchain is so basic compared to what you can do with the Ethereum ones and other ones that are so much more advanced. And it would be nice if it was on a more advanced one so you can do these things, but will it ever be able to get upgraded to do that sort of thing? They add things to it, they do stuff, they fork and things, but it seems to be behind technologically.
Yeah. And, well, going deeper into the market structure, so there are probably two things coming from FX space that are adopted in crypto. Like, one of them is the exceptional fragmentation. I think we all should agree that crypto is probably the most fragmented asset class comparison to even FX, we have like multiple, like a few hundred venues, even just the execution venues, and then like a few dozen of market makers, even like the established tier ones that are way more like secondary LPs and the market makers. So what do you think about the market fragmentation? Do you believe it will be even more fragmented? Do you think it will be consolidating? What's your stance on that?
It won't be more fragmented because most of the people lower down are just feeding off the people above. So they're sort of parasites of the people above. So they're not really providing market liquidity. They're just distributing someone else's. It's recycling. Providing someone else's liquidity, exactly, yeah. So I think there'll be consolidation more. And you're starting to see real changes in the exchanges that are appearing. They are much more like a traditional recognized investment exchange in futures. They have the sort of technology you need. They have UAT systems. They have, you can onboard with them properly. They have development partnerships. They have the ability to do something that is more reliable and and scalable. Yep. They have market supervision. They have people that can talk to you. So sort of examples that would be like sort of Zodia, Bullish, OKX. They're just much more grown up. I mean, Binance is significantly better than it was. We can talk to them. We have people we can talk to there. So it's learning by changing. But some of the new ones it's very refreshing whether they're coming in. GFOX, I particularly like that because they've really taken the proper exchange model with really grown up people and built a fantastic system. I hope that becomes really successful and really popular, and I really like the guys there, and I think they've got an extremely good chance of doing that because they've built it really well. Really, I know them quite well. I met them a lot. They are excellent.
Yeah, well, and also quite agree. We'll see the shift, especially due to the local regulation. There will be lots of offshore names that might be losing their market share over to the onshore regulated, like properly regulated and properly structured exchanges with less conflicts of interest, without running their own market makers on the hood and all sort of other different tricky things. And there's a second thing which I wanted to discuss about, like some similarities with FX, is the last look component, which is like widely applicable in the space by some of the market makers. And as you mentioned, like what FX was 10, 15 years ago is a Wild West. I think crypto, like 3 to 5 years ago, was also kind of Wild West, and also on the last look side. So what's your stance on the last look, like in general and particularly in crypto?
I would love if they were all not last look because you're going to get no latency, you're going to get no rejections, you're going to get guaranteed execution. What I have unfortunately found is that there's fewer people who are willing to offer liquidity in that way because they are really worried about being able to get their prices in and out of the market quick enough. The other day we were aggregating for one of our clients. We were aggregating, I think there were 5 coins, and it was quite a busy time in the market. And we were pushing out 28,000 price updates a second, which is insane. And if you're a no last look market maker, and you've got to be able to keep your order book up to date, it's almost impossible with the latency you're going to get going backwards and forwards to keep your order book up to date with the venues. It's really, really hard. So whilst it's a much better model, I'm not seeing enough people want to keep doing it. I do hope, and I know you're entirely a no last look model now, and I do hope that will be able to continue because it is great. It's a bit like when you, in the FX world, executing against LMAX, you're executing a price against a price that's not going to go away when you hit it. So you get almost no slippage, and it's great. But are they widening their prices because of that risk to be able to offer that? I suspect yes. So it might be one of these things that can't stay. I hope it can stay because it's better for the consumers of the liquidity.
Yeah, well, I think in the end of the day, both models should live in parallel so that the actual client can decide whether they want to use the last look or the firm model. But do you see more liquidity providers tending to migrate and support the firm liquidity, or you don't see that trend?
I see more migrating the other way. We've had market makers who will no longer do no last look, and they will only do with what we would call the traditional LP model of they stream us prices, we send them orders, and they execute.
Yeah.
Now, some of them it's because they're not really an exchange, they're not really a market maker, they're actually an aggregator from somewhere else, and they just call themselves exchanges. So they can't do no last look because they have to generate an order somewhere else. But other ones, they're not comfortable with the level of risk, I think. But
And you mentioned LMAX, which can be quite toxic in terms of like the no last look, and I think the whole thing is how to balance the interest between the taker and the maker.
yes, absolutely.
So
you've hit it on the head there. It really is, because it's not all one side.
Yeah.
And if takers have the ability to be more demanding because they're in the power seat, then and they demand to have no last look, then the makers will have to do it. And if the technology settles down and the price updates don't get completely insane and it gets a bit more sensible, then they will be able to do that. I mean, that 28,000 a second was just silly. I mean, nobody wants that sort of level of price updates. I think that's because so many people are feeding off other people. So one Bitcoin price changes once, and 400 people reprice. We had a client that wanted to be able to trade against the order book up to, I think it was $20 million worth of Bitcoin in each clip.
Yep.
So to create an aggregated feed that they could do reliably all the time, this was on exchanges they were doing this, and we were aggregating between exchanges. We had to go down, I think, 250 levels, which is absurd.
The client should have come to Finery Markets. I mean, that could easily be executed on a firm basis.
This is what we've now moved them to, because they said, we want exchange. We said, you're going to have an enormous level of depth to do that, because there just won't be the volume there. The top 50 levels are all tiny. And so we did, and they went, we can't really cope with that. And I said, the update rate's going to be insane, because they're updating all of the time. There's little people doing this. What you actually want is something else. So exactly. So your sort of market, people like Route 28, those sort of things where you can get good depth. So actually that's what we've now moved them to, because they were very, very certain that they wanted to have exchange. And we sort of showed them this. If you want to do what you want to do, your counterparties are really retail punters on something like Binance. And you want to trade $20 million. There's a bit of a mismatch of goals there.
Exactly. And the market impact, it's completely different what you can get even on Binance, even being the largest exchange. You would be way more secure doing that over the ECN model. Yeah,
absolutely. Yeah. So I mean, we are seeing an awful lot more through the ECN model now, because we can also create custom order books, and we can create, someone can say, okay, I want the order book to be to look like this. So I want my top of book to be up to 10 Bitcoin, because I've got someone who's trading this size. So if I'm showing them the top of Binance book and it's this wide, but I can only buy one Satoshi of the thing, it's no use. They're going to say, you're slipping me every time. It's like, so if they're typically buying one Bitcoin, then show me one Bitcoin VWAP price, because then they're not going to get slipped much from what they see. Right. So they feel happier, and their models will work. So that's quite a useful thing, actually. We do find quite a lot of people like that custom order book type thing that we can do from various places. But it's interesting how it's moving more into the favour of the market makers at the moment.
Yeah, but I think once we have more client demand and more and more institutions coming to the space, we will see that balance of interest, and everyone will find its own model. And how do you see the overall share of exchange-traded flow in crypto and exchanges, that's how they call themselves, versus the OTC space? So how do you see that changing within the next probably 2-3 years?
I think the biggest change recently was Binance deciding to abandon their VIP9 for aggregated sub-accounts. Made an enormous difference, because there's a whole load of stuff with HRP that they're no longer, you wouldn't go to them, you only went to them because you got this extremely good beneficial thing. So I'm seeing them losing vast amounts of share because of that, because OKX have not done that. They have carried on. Also, if you have the prime of prime model we're talking about, you don't have that problem, because you're not aggregating sub-accounts, you're aggregating liquidity into one account. So
so you're acting as a principal. So all of a sudden, you're benefiting more.
So you're benefiting more people. So maybe there'll be a sort of swing back there, but at the moment, it's definitely swinging much more towards the market makers. They've also got more flexibility to do curated liquidity for what people need, because it's not all the same. As I say, we were saying, really, really retail stuff in an exchange is not the same as institutional. In the FX world, you don't have someone who wants to buy 0.01 lots of cable going to an investment bank. You have intermediaries in between who will aggregate all the flow and put it all together and be the right sort of venue. So I think you see the same sort of thing developing in the institutional crypto space. It will be the right liquidity for the right takers, so a match between the two.
Yeah, I definitely agree with that. And if we talk about some other trends in the space, and not even particularly crypto, but overall FX and CFD trading, there's been a massive trend over the last couple of years with the prop trading firms.
Yes.
So maybe you can explain in brief details for our listeners what is a prop trading concept, that how do you guys address that growing demand for the prop trading industry?
There is enormous demand in that at the moment, and we've got quite a lot of prop trading clients. They're very keen to do this. It's again a funny word like exchange, because proprietary trading is what the word comes from, is perfectly normal. You're basically saying I'm trading on my own behalf. So the way it started was actually in the futures markets. You had a room where the firm would provide they were called arcades, and they would provide a screen that you could sit at, because you couldn't do it over the internet then. So there were a room full of trading screens, and as a trading arcade it was called, and people could go in there and they would let you try and trade and see whether you were any good. Then they didn't have sort of test markets, so you'd had to play on a real market, but which is very small amounts of money. And if you proved you were good, then either they would match fund you, or they would fund you, and they would take a profit share of what you do. So they might take 50% of your profit. And most of them would not make you wear the losses, because they put you through that first test, which is basically what prop trading is now. They've just taken it to a slightly different model, and it's suddenly sort of started exploding. So now you have it's a bit more standardized, I guess, how it works. So you have the concept of a challenger account, so they call it that. So that's where it's slightly different is you're paying a monthly fee. So as someone who wants to use a prop firm, you might pay, I don't know, $100 or $200 a month to the firm, and they will allow you then to prove that you're good. And most of them are making a lot of money out of that. So they just want to sign up as many people as possible in the challenger.
Exactly.
And they don't really want to take you further. If you prove that you can trade, then they take you to the next level, and about 10% get through that. Then the model would be they will fund your account, and they will share the profit with you. Some are different, some where you have to match share, and some you fund yourself and they'll take some of the profit. But basically the model is that. And there's nothing fundamentally wrong with that model, because you're doing education. If you're doing education, you should be educating them how to trade, proving that they can trade, so you know that, okay, they're good, they know what they're doing, and then allowing them to trade, and you both make money out of it. I think the problem is it's in absolute hype mode, and there's an awful lot of like fraudulent prop firms coming out.
And the quality of that education can also be quite questionable.
It could be internet influencers, who are my pet hatred in financial markets, because they get up there and they say, do this thing, you can make a fortune. It's like, oh, God. And they know they'll get fined $1 million, but they'll make $10 million. So they don't really care that all these poor people that are watching them don't know anything about markets, are going to lose everything. But they're going to make $9 million out of it as the influencers. That annoys me. So you're right, the education is woefully lacking. So I would hope that they can stay, and they will be regulated in the way that if you're educating properly, there's nothing wrong with doing this in the correct way.
So that's actually a good point. So I wanted to discuss it in more details, because it's not really a financial regulation. It's more of a regulation on the way you educate, and how do you provide like the disclaimers and like the risk policies about what is actually that you are sharing as the educational knowledge, and what's binding and what's not binding from that influencer or whoever is doing that educational piece.
Yes, yeah, absolutely. It needs to be much more structured and much more sort of formal. Otherwise, it's going to be a copy of the binary options market, which was just extraordinary. I remember I went to a conference in Tel Aviv, and I was chatting to this affiliate marketer girl about what she did. And she just said, well, I just ring people up all day long, telling them they can make a fortune. And I said, what is the typical client that you would have? And she said, okay, the typical model of a client we would have would be a young chap who's got £100 in his pocket, and he doesn't know whether he's going to go out and drink a lot of beer that night, or he's going to buy a binary option and lose it all and not go out that night, or he's going to make double and he's going to get even some more smashed. And I said, what's the lifetime of these clients? And she said, a couple of weeks. And then they blow up, and then we get another one. And it was just like, oh my God. So I hope it doesn't get to that point. I haven't had any cold calls from people trying to sell me prop stuff yet, but I do get quite a lot of calls, normally coming from some sort of sweatshop in India or somewhere saying, you should trade Forex, you can make a fortune. I get all that, and I just will say, well, who are you? Which firm are you representing? And they say, oh, Forex. And you say, no, what was the firm? And they won't. As soon as you probe a bit more, they put the phone down and they realise that you sort of know what you're talking about. So, but it really worries me. And if any of my children ask me, should you be trading the markets, just saying, no, you don't know what you're doing. If you don't know what you're doing with it, I can guarantee you're going to lose everything.
Exactly. Well, could not agree more, and hopefully we'll see more regulation in the space. Otherwise, it can become like wild. It also draw some, like I would say, improper attention, and it's just not good for the industry entirely.
Absolutely correct. I mean, most of it is not in crypto, actually. Most of it is in FX, actually. But I expect to see it coming into crypto in the prop firms very soon, if it's not now.
And overall, so what are the biggest challenges and risks for the trading technology industry that you see right now? And maybe there's something that keeps you up at night.
As an entrepreneur, one always wakes up at 3:30 in the morning panicking about things because you're either very rich on paper or you're not, and it sort of goes up and down, and competitors coming in, regulators doing things, clients disappearing. We had a client, Flowbank, that just went into administration last week. Absolutely no sign that this was going to be happening. Suddenly they disappeared. These sort of things can happen, and those sort of things worry me. I think the way I keep ahead of that, so I don't worry about these sort of things, is to make sure that we're real thought leaders and that we are really pushing ahead, and we really are talking to our clients a lot. So we go out and we sell on a consultative basis. So we will go out and effectively do free consultancy with our clients to help educate them. And the process at the end of that will either be we're the right fit or we're not, and then we'll recommend a competitor. And that works so much better than trying to sell something that will not be the right fit.
Yes, because in B2B, it's also about the relationship that you build rather than the actual selling the prop trading or FX.
Because it's very rare that we'll build a relationship and someone will say, oh, I've just found something a bit cheaper and I'll go and get it. It does happen. And we had it recently with someone, which was slightly annoying because we put a lot of effort in. And it probably won't work out because there isn't a relationship there, but it does happen sometimes. So selling on lowest price, it never really works because it's not a match of what you need. So we do really look for, it sounds a bit cheesy, we do look for proper partnerships rather than just as a supplier, because it's so core to the buyer of our services, what we do. It's their business. Without our staff, if our staff stops working, their business stops immediately. Yep. It's not just like a nice to have. It is everything. And so you wouldn't just buy the cheapest thing to do everything. If you're a chauffeur, you don't buy the cheapest car you can get because it's not going to work reliably and you can't do your job. So we do try and build those relationships really, really well, and that's what the reputation that we've got is for excellent service and excellent relationship building and understanding of what they need, rather than just being the cheapest on the block.
Speaking about the challenges for the industry, just not yourself in particular, but about the industry in general on the trading technology space, what do you think are the main challenges right now?
Well, I think getting regulation properly in place so that people who are regulated can use these markets properly, can use the spot markets, is important. Banking is probably the biggest one. The lack of banking support. There's so many people who can't get bank accounts if they're doing anything in crypto. If they mention to their bank that they're doing anything in crypto, then they get debanked immediately.
Yeah.
So that's. I find it a little bit silly that, say, in the UK, the Prime Minister says we're going to be the crypto centre of the world, yet most of the high street banks will shut you down if you were to say you'd ever received a crypto. They don't really understand it. So they need to get the difference between a stablecoin is not very risky. They pick one example of something going wrong like UST and say, oh, well, it's all bad. It's like, that was one. There's lots of other, but the chance of not getting paid is much higher in some parts of the world than the risk of having a problem with the stablecoin. So I say that side of it. So traditional finance through the banking bit and regulation, accepting it as something that's going to stay is really, really important. more. I think liquidity is developing nicely anyway. I don't think there's fundamentally things that are going to change with that. DeFi, I love that. I think it's really interesting. I don't know how it will be accepted. It won't be accepted by banks and things for a while. It's too complicated. It's too unknown. There's too many risks, and they don't know who they're trading. So there's a lot to be done there. But I think I really feel that's got some future serious potential.
So we're also looking forward to that. And maybe just to sum up our conversation, we have our regular question is what 2 books that you can recommend to our listeners? Maybe something on the personal level, that like one of your favorite books, and another one on the like the business education or like some professional literature.
Yeah, I thought about this before, and there's one that is I didn't even have to think about. It's The Hitchhiker's Guide to the Galaxy. Is the definitive best book ever written in the world. I don't know if you're a fan of Douglas Adams.
Yes.
But if the listeners or the viewers haven't read it, it is brilliant. His wordplay is superb. He was so clever, and it is the best book ever written. It's just so clever the way he twists the words around. So I love that, and I go to that all of the time. I've read it multiple times. I've got the trilogy in 4 parts, signed by all of the radio cast. I went to a conference in London in 2009, and they were all there. Douglas had already died, so he didn't sign it, but Peter Jones, Simon Jones, all of them were there. They all signed it, which is and we went in dressing gowns and had towels, so we did the full thing, and it's just brilliant. It just sort of really levels you the way he uses the words.
And I would strongly recommend to read it in English in the like original.
I've never read it in other language, so I didn't know it. I guess it has been translated into other things, but
for sure. Well, I think we have clients and listeners for like 35 different countries. So
does it translate? Does the humor translate well?
Well, I mean, I also read it in English, so I cannot tell for any other language. But I think books like that, it's with the play on words and just the language that he uses. It's
because I imagine some bits. He's playing on the words, like where he says, I got so drunk I felt awful. He said, well, what's wrong with being drunk? He said, well, you ask a glass of water. So it's the words play on that meaning two different things that may not work in another language, because they might have different words for those two things.
Exactly.
But I love that. So, and the second one is much more of a recent one, and I thoroughly recommend people either listen to this on Audible, which is what I do a lot actually. It's called The No Bullshit Strategy by Alex Smith, and it's excellent. Somebody recommended it to me from a CEO's group I'm a member of. And I really like it because, having done an MBA, you look at writing strategies, and these are all fancy big documents with lots of stuff that no one ever reads, and you stick it in a drawer. Or it's so sort of generic, it doesn't really mean anything, and you could explain it in many different ways. And the point of it is supposed to be you're thinking about where you're going in the business, which direction are you going in. In something very dynamic, you can't do a 10-year strategy in our world because it changes every 5 minutes. But you have to have a direction of flow of where you're going in, and then be very flexible on that. And what this no bullshit strategy is all about is really aimed at SMEs, so most of the market. How should you compete? How should you define and communicate your strategy? And he doesn't really even like using the word strategy, he says, because people think that's some sort of bullshitty thing. It's sort of like, how should you, and he says you can't use the word vision or your why, because there's again, a bit bullshitty. It should be a Word document of 2 or 3 pages rather than PowerPoints, because then it can be interpreted in any different way in a picture. And you need to think about how you compete. And this is probably the most important one for me, is do not copy to compete, because you will never get there. Because if you've got a much bigger player, they will almost always be able to just copy what you've got if it's good. Whereas if you compete on differentiation and you do things differently, and you use your knowledge and you use your connections in the market to do something differently, it's extremely difficult for the competitors to do that. So we very much focus on competing by differentiation. We are the only ones in our space we've come from to go this deep into the institutional crypto side. And I'm very pleased that we did, but it was, it's a risky sort of thing to do. So I really, really like that book. I really, really recommend that one.
Perfect. Well, thanks a lot, and we'll definitely post both links to both books. And Tom, it was great conversation. I'm certain our viewers and listeners enjoyed that. And thanks once again for coming to our podcast.
Well, thank you so much for having me along. And you say I'm a big fan of what you're doing in Finery. And it's really, really good stuff. It's great. You've done such an amazing job on it.
Thank you. We're only just starting, so
excited absolutely. Where's it going to go? It's just even more exciting, isn't it? Yeah.
Exactly. Thank you, Tom.
Thank you very much. Thank you.